Okay, if everybody's ready, we're going to go ahead and get started. This is a relatively timely topic. We're going to be talking about trading and hedging with gold futures and options. It never fails. If we schedule a webinar, it's guaranteed it's going to be a wild and crazy day in the markets, and today was no different, so bear with us. So if you're not familiar with who I am and what I do, my name is Carley Garner. I am a futures and options brokerage. Well, I am a broker. I run a futures and options brokerage in Las Vegas, Nevada. And it has nothing to do with gambling and trading. It's just because the weather is much better in Vegas than it is in Chicago, where most of our colleagues reside. If you have any questions about anything we talk about today, you can reach me at cgarner@decarleytrading.com by email. I try to be pretty quick in responding. You can visit our website, decarleytrading.com. There's plenty of educational material there. It'll keep you busy for a long time. Articles, videos, all kinds of fun stuff. You can sign up for free trials of our newsletters. If you're on social media, check us out on Twitter, Facebook, and Instagram, as well as YouTube. We have quite a few videos, just like the one that we're creating today, that we post on YouTube, but we also do market updates. So we pick a market every once a week or once every other week, depending on how busy we are, and kind of do an expose on it and post it to YouTube. So check us out there. Also, as a warning, if you don't like pets, you probably don't want to follow me on Instagram. I post a lot of pictures of my dog. And there's my dog. Believe it or not, this picture was taken about 20 miles from my house in Las Vegas, and this is at 9,000 feet. So people think of Vegas as a desert, but there's more to it than that. I am a broker, a strategist, an author. I also do our IT and our web development. I'm just kidding, but it's a small business. When you're a small business owner, you do a little bit of everything. But I do write a column for Stocks and Commodities magazine. I contribute content to Jim Cramer's Mad Money. I just did a Bloomberg television segment a few minutes before I jumped on here. So we do those sorts of things. And if you're a client of ours, you would receive newsletters discussing the markets and providing trading ideas. Of course, they're ideas. You don't have to do what we do or take our advice. They're there for educational purposes and to help people maybe get some ideas on things, whether it's strategy or timing or whatever might help them. I've written multiple books on commodity trading. These are the three newest. These are the only three you need to worry about. If you do a deep search into Amazon, you'll find a few others, but they are older and they are out of print. We switched publishers, and so the old publisher stopped publishing those books, and so you can find them on Amazon, but the list price is like $800 or something silly, so don't do that. All the information that you're going to need is right here in these books. Trader's First Book on Commodities starts from ground zero. Higher Probability Commodity Trading takes the next step. It talks about analyzing the market, different trading strategies, that sort of thing. And if you want to get into option trading, the newest book, which was just released a few weeks ago, is Trading Commodity Options with Creativity. The good news is it's selling pretty well. The bad news is Amazon ran through their inventory. They will have more copies on the way. So if you do order from Amazon, I suspect you'll have them within a week or two, not the 2-month time frame they list on the website. I think they're just being conservative. But nevertheless, if you go to tradingcommodityoptions.com, you will find that we actually have the book in stock. So if you want to order from us directly, you can do that at tradingcommodityoptions.com. All right, so before we get into the fun part, we want to make sure to remind everybody there's a substantial risk of loss in trading futures and options. Trading is not suitable for everybody, and I always like to add it's not suitable for most people. Trading is very risky. Sometimes it's a lot of fun. Sometimes it is the opposite of fun. So a few people commenting on our book. Seems that they are enjoying the new book, Trading Commodity Options. I will confess we've found a few errors in the text, which we are correcting. It kills me to even see that happen, but the reality is it's a 370-page book. It's a lot of information, and so it was bound to happen, but I'm a perfectionist. Everybody loves gold. Everybody loves to talk about gold, especially now. Gold is a popular topic. Is it the quintessential commodity? Maybe. When I think of the quintessential commodity, I think of crude oil, but a lot of people think of gold. A lot of people assume it's a good store of value in bad times. Some people consider it a long-term quality investment. We talk about how it's a hedge against inflation because gold and the dollar often move inversely. And some people call it a safe haven. despite all the good things that you hear about gold, it's not the perfect asset. Also, if you are watching business news stations like I do all day, you'll notice there's a lot of commercials telling you to invest in gold, sell off all your stocks, which are risky, and invest in gold. But the reality is, despite all of those conceptions, gold in the long run is not a good investment. Is it a good trading vehicle? Yes. Is it a good way to diversify a portfolio? Yes. I'm a commodity broker that makes a living with people trading gold, so I'm not telling you don't trade gold. I'm just saying be careful. It's not something that you buy and hold forever. It's more of a trade, and I'll show you a few long-term charts and it'll become very obvious why I would say that. And if you did happen to buy gold in 2011, you know exactly what I'm talking about. Owning gold has mostly been waiting and seeing. So there's been some really, really big rallies in gold, but those rallies are decades between each other. And in the meantime, while as people are waiting, gold trades sideways or goes nowhere. And you have to think gold doesn't pay dividends. Gold's not producing anything. There's no income. You're just sitting there on the asset. And if you're sitting on bullion, there's a lot of costs are associated with storing and things like that. So I know this is an unpopular opinion, but gold is not an investing market. It's more of a trading market. Now, if you were savvy or lucky enough to have bought gold several years ago, now you're enjoying this huge run up. That is awesome. But you may want to consider lightening up and protecting yourself because it's not going to go up forever. In fact, gold has never gone up forever. This is a monthly chart of gold. Actually, I updated this yesterday. I'm not sure why it didn't save. Anyway, we all know gold is now above 2000. So we're at new all-time highs, which is great. For anybody that purchased gold around 1,000, 1,300, even 1,600, you're still doing very, very well. But anybody that purchased gold in 2011 around 1900, it's taken them 9 years to get their money back. And that's assuming that they held on and rode it. How many people here would, after buying the highs in gold and watching it drop 40%, would continue to hold? Not everybody. I think few and far between. So I'm not saying gold isn't a good trading market. I'm just letting you know it doesn't always go up. It's not always easy money. We've seen the RSI, which is the relative strength index. We've seen that in gold pop above 75, 80 on 3 other occasions on a monthly chart in the last, basically since 2000. And on each of those occasions, we've seen a pretty decent sized correction in gold. In 2006, it was about a 24% decline. That's not so bad. In 2008, it was a 33% decline, also not that bad. In 2011, a 38-40% decline. That's a little tough to take, and that's a lot of volatility. And like we mentioned already, those traders had to wait several years just to get their money back if they bought at the wrong time. So all I'm saying is, if you're going to try to play the upside in gold from here, be really, really careful. If you've made some money on the way up, protect it. It's not necessarily a buy and hold market. Maybe this time will be different. I've been hearing that a lot, but I heard that in 2011 also. You have to think 2011, the world was melting down. We were in the financial crisis. It was really sad out there. The U.S. credit rating was being downgraded. Stocks were melting down. So there were a lot of bad things going on in 2011 when gold hit 1,800 for the first time. So back then, everyone also said this time is different. And guess what? It dropped 40% after that. So as exciting as gold is, it really has little industrial practical use in society, nor does it pay dividends. But the market volatility that results from human emotion creates plenty of opportunities for speculators and for those looking to diversify their portfolio. So that's been what we've been talking about. This is a chart of gold and the S&P. Most people assume that gold is a way to hedge stock market volatility, and in some situations that is true, but not always. I mean, if you notice, a lot of the time gold, which is the yellow lines that we see there, goes up at the same time as stocks. And that's what we've been seeing in the last several months. Gold and stocks have gone up together. So they're not necessarily negatively correlated like most assume. But if you could look out throughout several years at a time and sparse the data, they're actually maybe even positive correlation a little bit, not much, but more like neutral, which means it's a great way to diversify your portfolio. So if you are holding a traditional stock and bond portfolio, it does make some sense to have some gold speculation in there in small amounts, just because it's a diversification tool, just like real estate or anything else. Now, a lot of people are asking at this particular time, they're trying to figure out, how do I get involved? And there's really 3 ways to do it. You can purchase coins or bars. I mean, there's something to be said of an asset that you can hold in your hand and see it and touch it. But with that said, it's not that easy. There's a lot of inconveniences. If you're purchasing gold in the cash market, first of all, you're paying a huge bid-ask spread, like ridiculous, dollars and silver. Also, you have to store it, you have to transport it, so it's not as easy as it sounds. The most efficient way to do it is through either futures or ETFs. I'm a futures broker, so I'm going to tell you futures is a better way to go. It's not perfect because there's things you have to keep in mind, such as leverage and that sort of thing. But the futures markets are extremely efficient. They're liquid. They trade 23 hours a day. It's really hard to beat the convenience and the efficiency of the futures markets. So also, in addition to being traded 23 hours a day and being efficiently priced, more so than ETFs or cash market or any of those, they're tax efficient. Futures contracts and options on futures are taxed at a 40-60 blend between long-term and short-term capital gains rates. Also, you don't have to report each individual transaction to the IRS. You have one number on your 1099. You let them know how much you made or lost, and that's it. So it's really easy and convenient. One advantage, which is also in many ways a disadvantage, is leverage. Gold futures and options on futures come with leverage. If you're on the right side of the trade, we know that's great. If you're not, we know that's painful. But the nice thing is there are multiple contract sizes, and we're going to go over all of those because it's really confusing. There are different exchanges, there are different products, different underlying assets. It's really a lot to handle. So we'll talk about each of those. So what actually moves the price of gold? I mean, there's a lot of, everyone you talk to is going to give you a different answer. So of course, this isn't some sort of fact that I'm throwing out there. This is just the opinion that I've developed over the years. So gold really is kind of the fear index in a way, but that's not all it is. In my opinion, gold is an asset that's similar to fine art. It only has substantial value because humans, or we, say it does. That doesn't mean that it's worthless, because it's not worthless. Baseball cards aren't worthless, even though maybe they would be in a different world or a different time, but here and now, gold has a lot of value. In fact, every day the value of gold is going much higher. So it is what it is. Gold prices don't just move on human emotions and fear and so on and so forth. They follow seasonal patterns. It's also important to look at the COT report, which is where traders are positioned. If you're unfamiliar with the COT report, I can't really get into the details here in this class because it's just too much, but we do have a video on our website, carleytrading.com, that you can check out. Basically, the COT report is issued by the CFTC, which is the reports in any particular market. So for example, if we look at gold, we can see whether speculators, large speculators or small speculators, are long or short the market and to what degree. This is extremely useful information for me because I look at these things and I see if everybody's already bullish and everybody's already acted or reacted in the market and expressed that opinion by going long futures, then maybe there's a situation where there's just simply no buyers. The fundamentals might not change, but if there's nobody left to buy a contract, the only way for people to get interested in buying that contract is for prices to come down, and that's exactly what happens. The buying dries up and prices come down. If you look at a COT report of gold right now, we are not seeing the most bullish position of all time, but we're seeing one of the most bullish positions ever held in the history of gold. So in other words, there's almost more people long gold today than there ever have been in the history of the market. That doesn't mean that more people aren't going to come off the couch and buy gold, but it means that they're probably not going to. At some point, everybody that wants to buy gold is already in the market and the buying dries up. So here's a seasonal chart of gold just to give you an idea. This is the composite gold, meaning this is cash market prices. Seasonals are tricky, just so you know. Again, we can't get into it, but hopefully you know if you're here. If not, you should consider going and watching some of the videos on our website or reading a trader's first book on commodities. Futures contracts expire, so each expiration month actually has slightly different seasonals. So when you look at a chart like this, it's kind of meshing all those together. You have to keep that in mind. Seasonals are never going to be perfect because we're dealing with contract expirations. We're dealing with the fact that seasonals work most of the time, but not all the time. But anyway, with all that said, gold usually has two runs in any particular year, and it's usually in January and February, and then again in the late summer, early fall. This is interesting because we're looking at gold prices soaring higher now, the seasonal move started much earlier this year than it normally does, or maybe this is just the beginning of the seasonal move. I don't believe that's necessarily the case, but maybe it is. So seasonals, again, are tricky. You have to be careful with that. It's just a guideline. It's just a tool in the tool belt. It's not an end-all be-all. This is a relatively, actually this chart is updated, so good. We did update this yesterday. So you can see this is a COT report. This is what I was telling you about before. When speculators start to get a little too long, the buying has a tendency to dry up. It doesn't work all the time. It works most of the time. And sometimes the buying takes a long time to dry up. So for example, if you look here, hopefully you can see the circle. Long speculators got really long earlier this year. Gold topped out temporarily. We saw a pullback and then it just kept moving higher. So again, this is a tool. It's not a guarantee that gold's going to top out and roll over forever, but it just gives you a good idea as to where speculators are and what is most likely to happen. Now, a thing to keep in mind with the COT report is it lags a week. So you'll notice this figure right here, it doesn't look that out of sorts. Like we've seen higher, we've seen more buyers here and here than we have here, and prices are skyrocketing. But this report lags a week, so I can almost guarantee you when we look at next week's report, this number is going to be right around here. So we are probably looking at, if not all-time long positions in gold, pretty close to. So does that mean gold's going to turn around on a dime? You know, maybe not. But does that mean from here the upside's very limited? It does. Now, gold's a wild market and it's an emotional market. The crazy thing about gold is even, let's say if we're right and gold tops out by next week, that doesn't mean it can't be 2200, 2250 first before it does it. Just something to keep in mind. Gold is one of those markets you don't want to be naked short because it can get hairy. From judging, we can see that rallies do tend to stall when people get too long. This is really the same chart we were looking at before, but it just refreshed. We've seen in the past when RSI gets up here, gold has a hard time rallying, but we've also can see that RSI was elevated for a little while here, and gold still kept going higher before it turned around. I've actually kind of observed that gold tends to run, even from an overbought state, it'll tend to run about $300 before it tops out. What can I say? It's not very rational, but that's what it does. So we're wondering if that's the case, did the $300 start here around 1800 and now we're getting this $300 top end right here? That would be the last hurrah, and that would make sense. It's always easier to figure out where that $300 rally point starts after the fact. So unfortunately, how it works. So did it start here or is it starting here? I'm not sure. If it's starting here, we're looking at 2250. I know that's not very precise, but this is just a market that's out of control at the moment. Precision is not possible. If somebody tells you they know that gold's topping out at an exact price, then you should probably just hang up the phone or close your chat room because they have no idea. But there's a really good chance somewhere between here, which is basically today's price, up in the mid 2000 to, I didn't even get a chance to check it, 2070, somewhere in there, 2060 to 2250. Somewhere in that $200 range, gold's probably going to top out, but anyone that trades gold futures knows that $2,000 or a $200 move is 20 grand on a single 100-ounce contract. That's a lot of money for most people. That's a lot of money for me. So we're going to show you ways to play this with lower risk without risking your house and your car and that sort of things. I'm exaggerating, but nobody wants to get caught on the wrong side of gold. Trust me. I've been there. Okay, so let's talk about the different forms of gold futures and options. At this time, there are only options written against the full-size contract, so keep that in mind. That might change as we go. For now, there's only options on the original gold contract, which is 100 ounces of gold. Assuming gold's trading at 2,000, which we know is a little higher today, it's hard to keep up with the way the market's moving, but if gold was at 2,000, the value of that one futures contract would be worth $200,000. So a lot of people fail to recognize that. The margin on gold is about 9,000. So let's say somebody with a $10,000 account goes short or long, whatever, an original gold contract, they're trading $200,000 worth of gold in a $10,000 account. A lot of new futures traders fail to recognize that that's exactly what they're doing. They just think if the margin's 9,000, then no big deal. They've got 10,000 in their account, they should go long or short. That's a lot of leverage, and the odds of you making money trading on that sort of leverage are pretty slim. It could happen, but it's not easy. So the next step down is the E-mini gold, and this is half the contract size, so it's 50 ounces instead of 100 ounces. With gold trading at 2,000, that's $100,000. And then there's a kilo gold, which is 32.15 ounces. By the way, all of these contracts are traded on COMEX, which is the CME Group's division. It's their metals division. You might be confused. The original mini gold was traded on a different exchange. It was traded on the New York Board of Trade, and then it was sold to New York Stock Exchange, actually, a division of them, and now it's on the ICE exchange. So it skipped around a little bit. The symbol was YI. That's what everybody traded as a mini. The CME added their minis later on, and it took a long time for speculators to make the move, but they finally have. So now, if you're looking to trade gold, you really only want to trade these contracts, and then I'm going to show you one more that you might want to consider, but don't trade the ICE contracts. I'll show you the symbols to those in a few minutes. So we've got the original gold, the E-mini gold, which is half, the kilo gold, which is a third, and then we have the micro gold, which is only 10 ounces. So with a 10-ounce contract, you're trading $20,000 worth of gold. It used to be that the 10-ounce contract was kind of boring, didn't move much, but in today's markets, honestly, that's probably the way to go. Even 10 ounces will move quite a bit. To give you an idea, you're making or losing $10 per dollar. So if gold is up 40 bucks or down 40 bucks, which we've seen those kinds of moves pretty frequently lately, that's $400 on a micro. Also, on a side note, the micro contracts are fabulous to hedge options. So if you're a short option trader or spread trader or something and you just need to hedge, the micros are a great way to do it. And if you use deltas, the futures delta is 1. The micro delta, because it's 10 ounce, is 0.1. So for example, if you're short a futures contract but you want to hedge yourself, you could buy 1 or 2 micros against it to take some of the edge off. So just keep those things in mind. You can be creative. And the exchange will net your risk. The exchange recognizes if you're long or short an option and long or short a mini or micro future, and they net the risk. So you don't have to pay margin on both positions unless it's possible if you're trading with a brokerage that doesn't offer span minimum or doesn't recognize spreads, they might double charge you, but make sure you're trading with a brokerage that charges you span minimum so that you're not. Of course, I happen to be one of those brokers that don't. So if you're looking for a good broker, carleytrading.com. So this is a new product. You've probably not even heard of it. It trades on the small exchange. The small exchange is exactly what it sounds like. It's a new exchange that offers index trading in small, simplified, and partially diversified futures contracts. So this is a new concept. I emphasize the word new because it's all kind of experimental. It's going to take a little while for liquidity to pick up. I have noticed it's gotten better each and every day, but it's got a ways to go. That said, the contracts are so small, even if the bid-ask spread's a little wider, it's not a game changer because it just, honestly, it just doesn't really matter. So the precious metal contract represents gold, silver, and platinum. In that order, there's a larger percentage of gold, smaller percentage of silver, and then a little bit of platinum in that contract. It's cash settled, so there's no option to take delivery of the underlying asset. Some might believe this is a disadvantage, but the reality is less than 1% of futures traders take delivery anyway. The contract value is about $7,800 if this contract is trading at 78. The last I looked, it was about, the index was at 82. So we're still talking about $8,200 in contract value. If you remember, the micro gold had a $10,000 value and the full size gold was $200,000. So that just gives you an idea. This is actually even smaller than the micro gold, and it's somewhat diversified. The margin's only $264. So you're probably not going to get rich, but you're probably not going to get poor trying to trade this contract either. So it's a really good place for beginners, or if you're a paper trader just trying to test out your strategy. One thing to note with the smalls, they are traded on a separate exchange from the Chicago Mercantile Exchange. So you can't use those to hedge your options. So if you're trading options, you're short a call option and you want to hedge, the smalls is, I mean, you can do it, but it's not going to give you a margin break. So there are gold and silver contracts. I didn't list the silver, but there are metals contracts traded on the ICE exchange. If you're not familiar with the ICE exchange, it's the Intercontinental Exchange. Honestly, I don't think they want retail traders anyway. They charge $125 for data per month just to see live data in the platforms for their products. And they charge that regardless of whether you're a professional or a non-pro or whatever the case is. So I list 140 per month here because they also, on top of the data fee, they charge a New York City sales tax, and so it becomes almost 140 bucks. But it really just doesn't, there's no liquidity there, no reason to even pay attention to it. So don't accidentally trade these. If you see a ZG or a ZYG, just avoid it. Make sure you're trading the C and B versions of the metals. If you don't know, ask your broker. If your broker can't answer your question, switch brokers. So as we mentioned before, options are written against the full-size gold contract. At this particular moment, they are crazy expensive to buy. I mean, I've been taking phone calls for the last 3 or 4 weeks. People want to buy gold calls, and honestly, you missed the boat. If you wanted to buy a gold call, you should have done it a long time ago. It's just way too late now. The volatility is huge, so the options are really expensive. And I got to say, had somebody bought a few weeks ago at overpriced call option prices, they would have made some money because the overpriced options became even more wildly overpriced. So it is what it is, but it's really a dangerous game. And if you're an option seller, the margins are really high, and it's been a pretty dangerous situation to be in as well. It makes trading outright options, calls or puts, pretty tough in gold. But the volatility has created a lot of attractive spread trading opportunities. One spread that we've been kind of pitching to our clients are butterflies, because they provide limited risk, there's no margin, and there's a potential for a large reward. Now, in this kind of volatility, it's tough, so it's not a perfect strategy, but it's a way to get in with a small risk. And when I say small, I mean well under $1,000, with potential payout into the $3,000 or $4,000 range. Low risk, large reward, but there are some drawbacks, and we'll talk about some of those. So butterflies are far from perfect, as I mentioned, and it's because they're designed to benefit from a range, like they're range trades. They're saying, we think gold's going to be between, whatever, 2,100 and 2,300 at expiration. And so if it falls within this range, we make a good amount of money. If it doesn't, we lose what we paid to get in. The downside is if you're too right, if it shoots above your price. So in the example I just gave, if it goes above 2,300, the spread's worthless. So that's frustrating, because you think of, well, shoot, if I just went long the futures, I would have made thousands of dollars, and instead I'm out $500. So that's depressing. But what I can say is, in these types of market situations, everybody's focused on how much money they're missing out on, but the reality is there will always be a few people that make money on these kinds of moves, but a lot of those people are making money back that they lost because, maybe they bought the highs in 2011, or maybe they're just lucky, or maybe their strategy is designed to excel in this sort of environment, but they probably lose money most of the time and then have a big windfall in these kinds of moves. You shouldn't look at it as how much money you missed out on, but maybe if you survive and you don't lose your shirt, that's probably a good outcome. Another downside of the butterfly is you have to hold it to expiration. So you're handcuffed into the trade a little bit. And this is frustrating sometimes, especially with the market this volatile. A butterfly has a hard time losing value because the premiums are so pumped up. And I'll show you an example of a butterfly, but the idea is you're basically long 2 options and short 2 options. So the 2 short options will engulf your long options. You end up not really making money until you hold all the way to expiration. But a lot can happen between now and expiration. Maybe it goes outside of your range. Maybe it goes in your range and then it drops out. I mean, so many things can happen. So it can be a little frustrating, but that's just kind of the opportunity cost of getting involved in gold with a very low risk and a high profit potential. And I think you'll find if you can construct the butterfly in an environment like this, the odds of making money aren't bad. You can have really wide spreads. It's hard to predict where a market's going to go, but if you can predict gold within $200 or $300 or maybe $100, I think that's doable. I mean, maybe not, given the way gold's moving. So here's an example of one version of a butterfly spread. This is using the October options. I believe off the top of my head, I think they have about 50 days to expiration. And these prices were taken maybe yesterday or the day before, so they've probably changed a little bit, but this is obviously an example. So the idea is you buy the October 2050 call in gold. you sell 2 of the 2150s and then you buy a 2250. This trade is basically speculating that you think gold's going to land somewhere between 2050 and 2250. So you have a 200-point range in which you can make something, almost. We do have to account for the money that we paid to get into the spread, which based on this bid ask, you're probably looking at about $11 or $1,100 to get in. So our profit range is actually from 2060, because we have to make back the money we paid to get in, to 2240. And I'll show you what that might look like on a chart. And by the way, this screenshot is of our free platform, which is capable of option spreads. Some people hate it, some people love it. To be honest, it's built the correct way. It's built the way that floor traders used to quote spreads, like always in the buyer's perspective. So it takes a little getting used to, but it's super efficient. Okay, so this is the exact same trade, but on a futures chart, just so you can get an idea. So let's say we think gold's going up, and we think it's going to go in the next 50 days, it's going to be somewhere between 2050 and 2250. Okay, so this is where the max profit would come in at expiration. So if gold is exactly at 2150 at expiration in 50 days, you would pick up the entire distance between the first 2 strike prices. So basically, here's your break-even point, because you have to make the $10 back that you spent. I'm rounding. You actually spent $11, but we'll call it 10. So this is where the futures price has to get for your option to become in the money. The first $10 you're giving money back. Once you've recouped what you paid, this is assuming at expiration, you start making money until you get to the 2150s. But remember, you're long a 2050 and you're short 2 2150s. So beyond 2150, you're giving money back. And that's because from 2050 to 2150, you're making money on your long call. But above 2150, you're making money on your long call and you're losing money on 2 calls. So the loss on one of the 2150 calls is offset by your gains on the long call. But the other one is eating up your profits, and you give money back, and you end up breaking even again over here. Anywhere in between, you make something. If it lands right at 2150, and again, this is a big if, it would be almost impossible for that to actually happen. But if it gets anywhere in the vicinity, you could have a pretty nice payout. To give you an idea, if it was exactly at 2150, the trade would be worth almost $9,000. And that's because the spread between 2050 and 2150 is $100 in gold, which is worth 10 grand. Then you have to subtract the 1,000 you paid to get in. So you'd pick up somewhere around 8 grand. Now, I'm just being honest with you. These numbers look fabulous because it's like you're risking 1,000 to make 9,000. It sounds too good to be true. And I already told you the downsides of those. The reality is it's probably not going to land right at 2150. We've all seen how gold is, especially on the day of expiration. Shoot, it could rally or drop 50 to 100 points just in the last couple hours of the day. So it's unlikely it's going to be exactly at 2150. Also, to see those kinds of profits in the thousands, you need to get pretty close to expiration. So if you put this trade on and let's say gold goes to 2150 or somewhere in this vicinity in the next couple of days, there's going to be too much time to expiration. So what'll happen is the short option losses are going to eat your long option gains, and you might only be up a couple $100, $300, $400, $500 maybe at the most, until the market settles down and some time runs off. So again, it's not a perfect strategy, but if you wanted to buy the 2050 outright without any spread, it'd cost you, I think on the last slide, I think it was like $4,500, maybe even closer to 5 grand. So instead of spending 5 grand, we only spent 1,000. So that's the opportunity cost of that. Now, if you're the type of trader that would prefer to spend 5 grand on an option and let it rip, that's fine too. I'm just showing you another way to do it. But keep in mind, if you do spend 5 grand on an option and the market turns, that option value will go up in pixie dust almost immediately. Like it'll be shocking how fast it can lose value. Okay, so you don't have to have a spread that wide and that exciting. You can tighten it up. Now, you don't want to get too tight because If your butterfly is too narrow, if the strikes are too close together, you absolutely aren't going to make any money until basically the day before expiration. So you don't want to do that. But in gold, a $50 spread is reasonable. In today, like in a normal gold market, $50 would actually probably be considered a wide spread. In today's market, because we're moving so fast, $50 it's not what it used to be. But if you bought the 2050 call, sold two 2100 calls, and then bought a 2150 call, you have a $100 spread in gold to make money. That in normal circumstances, that actually would be pretty attractive. Today, it's a little questionable, but you can get into this spread for roughly $400. No matter what happens, that's the most you lose is 400. You can see the ask here up on the right-hand side of the ticket. So let's take a look at what that chart would look like. We can see the spread is much narrower. The profit zone is a lot more narrow. So it's not quite as exciting. This spread, you put up 400 bucks roughly. And I should also note the numbers I'm throwing out here are before transaction costs. So you do have to keep in mind a butterfly has 4 commissions. If you're paying 4 commissions and 4 sets of exchange fees, you have to account for those in your total risk and cost. So keep that in mind. But with that said, spread yesterday, or maybe it was the day before, I can't remember when exactly we were looking at these, could have been executed for 400 bucks. For 400 bucks, is if the market runs anywhere between 2054 and 2146, you make something. If it lands around 2100 at expiration in 50 days, you pick up 4,600 bucks minus transaction costs. That's not bad for a $400 risk. So again, not perfect, because if gold goes to 2,300, you're just going to be sitting there with a worthless spread. The nice thing is if gold turns around and drops 40% like it has on other occasions, you're only going to be out $400. So it's a way to get in with a possibility of a decent payout without very much risk at all. Hopefully you got something out of today's class. And I tend to be a little pessimistic, I know that, but that's because I've seen a lot of really painful experiences, and I'm hoping that lessons that I've learned or seen or observed, I can push onto our followers, and hopefully they don't have to learn the hard way. So I'm not saying gold should be off limits. I'm just saying be realistic about what gold is. It doesn't pay dividends, it doesn't produce anything, but it can move, and there are some opportunities to make some money there if you're right on your speculations. And again, it's a portfolio diversifier. It gets money away from stocks and bonds. And as we all know, in today's world, there's a lot of weird things going on in the financial markets, so it might make some sense to park some in gold. That said, with gold at these prices, you really want to be careful, because it could very easily, not predicting that it's going to turn around next week, but the odds are sooner than most people expect, it's going to turn around, and when it does, it'll probably fall pretty hard. That's just what gold has always done. Maybe this time will be different. We will soon find out, but I highly doubt it. I've heard that phrase. I've been in this business since 2004, and I have heard that phrase a million times to describe a wide array of scenarios, and it never works. The markets always generally do the same thing. The same pattern repeats itself. So again, if you're going to trade gold, I would advise you to do it in the futures markets, because it's more efficient. But also, if you're going to do that, make sure you understand how the leverage works and what you're getting into. So hopefully you're working with a broker that can answer those questions for you. I like the micro futures and the small exchange metals because they're small. Like I said, the contract size is 10,000 for the micro and about 8,000 for the smalls exchange metal future. Those are situations that most people can handle. To put that in layman's terms, so on the micro futures, the margin is like less. I think it's about $1,000. It might be even a little less. If you had a $10,000 account and you went long gold, for you to burn through that whole 10 grand, gold would have to go to zero. Not saying that's impossible, but it's not likely. So it's a really efficient way to trade gold. And keep in mind, people are scared of the leverage. You don't have to use the leverage. You can avoid all leverage by funding your account with the contract size. So if the margin in micro gold is 1,000, but the contract size is 10,000, if you put 10,000 in an account, you've eliminated all the leverage. So the exchange does not control the leverage. You do. Most people don't understand that. And don't forget about option butterflies. They're a great way to get involved without risking a lot of money. So it's probably a much more pleasant experience. I appreciate your support. If you want to learn more about trading futures and options, visit decarleytrading.com. You can sign up for a free trial of our client newsletters. We'll give you some ideas, commentary, trading ideas, that sort of thing. And please, if you're interested in option trading, and if you liked what you saw in today's class with the butterflies, we go into a lot more detail in our newest book, Trading Commodity Options. The book is available at any major book outlet. Amazon does have it, but they've temporarily sold out. I mentioned earlier in the class, if you go to purchase it from Amazon, they should have it to you within a week or two is my guess. I can't guarantee, but I'm thinking that's probably the timeline. Their inventory just ran thin. We do have them on stock, so if you want one a little quicker, go to tradingcommodityoptions.com. We can get you an autographed copy. Okay, here's my contact information. If you have any questions or anything, please let me know. I'd be happy to answer those for you.